Thank you. Well, now that we've raised expectations, it's a pleasure to be here. Thanks for coming out on a Tuesday night to learn about financial projections. You are a courageous lot. As far as I'm concerned, I'm a simple guy, so I divide the world into two types. There are poets and there are quants. Quants are people who are just sort of naturally good with numbers. They get it. The more complicated, the better. They're not afraid of it. But the truth is, most of us are poets, meaning we're kind of queasy about finance and numbers. And, it's not even so much that, we don't know how to add or subtract. That's not a problem. It's that we just get intimidated by the language of finance, by maybe spreadsheets. Maybe we're intimidated by people who have a lot of money. And maybe most importantly, we're intimidated by sort of speaking a different language that we're just not comfortable with, because often as entrepreneurs, we're creative, we have great ideas, maybe we're people-oriented. Now, if you're a quant, relax, you can just sort of sit back. But if you're a poet, don't worry. What we're here for today is to make it simple, plain. I'm not going to try to impress you with anything complicated. On the contrary, I'm sort of going to try to show you that this is something that you can pick up. It's kind of like easier than O-level math or anything like that. It's something that it's very simple in many respects, except in one respect, which is it's actually related to your business, and your business is, a complicated beast. And so the main thing we're going to try to show you today is that understanding financials is really just using a different language to talk about your business. And if you know your business, you'll quickly pick up the language. That's not a problem. Obviously, if you don't understand your business, you're going to have difficulty in translating it into that language of financial projections. So that's the spirit of what we're going to do today. I basically just sort of want to get rid of the scare, the scariness that most of us have when it comes to finance, and tell you, here's the things that you really need to think about, and they have nothing to do with math and numbers. They have to do with your business. So, this is supposed to, why isn't this building? Oh well, never mind. Magic mirror in my hand, who is the fairest in the land? My queen, you are the fairest here, so true, but Snow White has 1,000 times more EBITDA than you. I'm sure you've heard that fairy tale many times. What on earth am I talking about, other than loving fairy tales? Think of the mirror. And this is a way for you to remember the mirror. Because if there's one thing I want you to remember about this lecture, financial projections are a mirror. Why? Well, here's the first mirror image, which is a financial projection is really a translation in a language that's not called English, that's called spreadsheet. But it is just a translation of something that you probably know or that you're learning about, which is your own business, your strategies. So financial projections just reflect the strategy, the milestones, maybe the scale of your business. And very importantly, it's going to tell us something about the viability, whether the numbers add up. That is one of the most fundamental things that we do. But if you have a good business, the numbers will add up. And if you don't have a good business, they won't add up. So it's not the financial projections themselves that are the problem. It's understanding the business. And this is just a language or a reflection, a mirror that will give you a better way of looking at it because it actually quantifies it. The second mirror I want to give you is the mirror tells the witch the truth. Maybe a truth that she didn't want to know. Financial projections tell you a truth that you may or may not want to know. It tells you in a different way what your business is about, and sometimes very painfully, it forces you to think It forces you to say, how am I going to do that? There's a bunch of items here. I'm supposed to fill in a bunch of things about costs, and I've never thought about that. Oh my God, it's true, I will have to need to hire some people. What does it really cost me to hire people? And you go and you find out something about your business that's really important. How do I recruit the right people? What do I pay them? But it's just the mirror. It's not the financial that's difficult. You have to go and find out. It tells you what you need to do in some sense. And the third mirror image I want to give you is financial projections are actually the way that you project yourself to a particular set of people that you're going to at some point talk to, which is investors. And this could be because you're doing a crowdfunding campaign. This could be because you're talking to some angels. Maybe you're going to get very sophisticated and talk to venture capitalists. But it doesn't really matter. All these investors want to have some notion of financial projections. And they look at two things. One is they look at your numbers. They see whether they think this is a profitable business, how big it can get, all of that stuff. But more important than not, most investors that I talked to said, when we look at the financial projections, we figure out how the entrepreneur thinks. What level of detail, what kind of view of the world do they have? So they use this as a mirror to look at you because they want to see how you're thinking about your own business. And frankly, they know that the numbers aren't correct. But what they want to see is whether you understand your business. So 3 mirror images that I want you to remember about financial projections. So let me sort of, jump into the dirty truth right away. And here are a couple of limitations that we have to know. Rule number 1, financial projections are always wrong. That's true. And in a startup, they're completely wrong. But that's okay, because we're dealing with an inherently moving object. A startup is not something, it changes every week. Extremely difficult to figure out the timing. Financial projections do ask you to put some assumptions about when things are going to happen, and they always happen later. We just don't know when. Beware of false precision. You can waste a lot of time trying to get your financial projections perfect. If you're a quant, that's a real danger, because maybe you love financial modeling and you're going to get into all sorts of detail that's completely useless, because you're not dealing with a predictable, established business. You're dealing with a startup where everything is topsy-turvy. Financial projections are always out of date. 1 week after you build them, you've changed your model. You've changed something. These startups are moving targets. There's no way that these financial projections can be up to date. And it doesn't really matter. You do need to update them, especially if you're going out to meet new investors. But that's just the nature of the game. Financial projections are always optimistic. There's just a certain code of conduct that you have to learn. And the code of conduct is very simple. As an entrepreneur, you're already an optimist. Otherwise, you wouldn't have started a business. You believe in what you're doing. Obviously, you're going to be on the optimistic side of projections. So you then sort of say, okay, you go in front of your investors and say, all of my financial projections are very conservative. I don't know why they always use the word conservative, but every entrepreneur I've ever said in every presentation uses the same sentence. My projections are conservative. And the investors ignore it and know that they're optimistic anyway. There's a bit of a sort of cat and mouse game about whether you want to game that, whether you sort of want to inflate your financial projections. My advice is don't do too much of that. Do the projections that you actually believe in. And you will get feedback on that. Some people say you're completely off the chart, or they will say, why aren't you more ambitious? But it's a good starting point to put down what you actually believe. Very important, I'm going to talk about financial projections, and maybe at the end I'm going to talk a tiny little bit about something that is important, maybe more important, it's financial management. What's the difference? Well, projections is we're just trying to plan our business going forward. Financial management is we're actually managing our accounts, we're managing our cash. Clearly that's going to be super important. They're related, but don't confuse the two. also, when you're doing financial projections, you're going to have sort of some high level. You have a couple of spreadsheets. That's not an accounting system. An accounting system says money in, money out, and you need something separate. Typically, once you're established, you have an accounting system, and that accounting system generates numbers or reports that you then use to separately create the next financial projections. But they're not the same thing. So what I'm going to talk about is how do you develop these financial projections. Now, did I put the why? No, let me just say why. You might be sitting here saying, I'm an entrepreneur, I just want to do my business. Two main reasons. One is for your own planning, your own sanity. You should think about all the resources that you're going to need. And as I said, it's not about the numbers, it's about thinking about the underlying business. So this is just a tool that will discipline yourself in thinking about your own business. And then when you do get to investors, when you actually need money, you're expected to have them in some form or another. Okay, so here's my cooking recipe. Use 2 pounds of fresh primary market research, mix in a cup of secondary market data, lightly sprinkle some theoretical reasoning, decorate subtly with wishful thinking, and serve hot. You get the idea. Primary market data, that means a lot of what we're going to do is we're going to gather the key information by talking to people. And I'm sure by now, in lecture 7, you've come across this notion several times of getting out of the building, talking to people, talking to customers, talking to experts. Those are the raw materials that are going to give you a lot of the answers and a lot of the financial projections. Secondary market data, that's basically data that you can find on the web, in the library, that's already documented about your industry, and some of that is very useful in building your financial projections. You have to add some theoretical reasoning, which is you have to project what your business is going to look like, and the wishful thinking, I know you know, I'm sure you know how to do that. So now let me get down to sort of the basic mechanics. The basic mechanics is we're going to try to figure out what our revenues are, and then we're going to try to project our costs. So the very first concept that we should be very clear about is we're sort of separating revenues, costs. Now, obviously they're related because, our activities that cost us things generate revenues, but it is useful and from an accounting perspective essential that we sort of distinguish between the money that comes in and the money that comes out. And so we're going to then project all sort of costs. And based on that, you should spend most of your time on those first two. We can then build the projections. And the projections in the world of business tend to be in a certain set of statements. The 3 statements are cash flow statements, income statements, and balance sheet. If you study accounting, you go into great detail of what goes in there. The truth is, today, most of the time, you can figure out some software that will produce those for you. And you need to know a little bit more language, the language of accounting, to produce them. They're not even important. Some investors don't really bother too much about them, except for the cash flow statement. But this is what underlies them and where all the action is. You can then, present your financial projections, and eventually you have to manage your cash, as I said, but that's really a separate topic. Okay, so how do we project our revenue? Here's a deep formula. Revenues is price times volume. That's basically as simple as it is, except we need to think about what do we think we're going to get, price, and how much are we going to sell. The first thing we have to do for this, we have to define our units, our counting units. So depending on your business model, that's going to be very different. Typically, we sort of think of an average. You could model every consumer differently, and you can very quickly get very complicated. Just think of your typical consumer. And so, in a museum context, you're building a museum. Well, it's basically the ticket price. Right? And so it's one ticket. Now, you could get complicated and say, well, there's a discount for elderly and children. Keep it simple. Keep your revenue model simple. Just think of an average price. in the context of a restaurant, well, everybody eats something different, but the way you do financial projections for a restaurant is you think of the average ticket of an individual or of a group of people. What, on average, do people come in this kind of restaurant? On average, they spend 12 pounds, or they spend 60 pounds, or God knows what. Now, you can think about each of these. I'm not going to go through them. But if you're sort of curious, you can do this as a little exercise for yourself and think about each of these businesses and say, how would I price that? Just to show you, some of these are really completely different. I mean, if I'm a fashion consultant, how do I, what's the unit? Probably the unit is a day of consulting, or it's a customer, and then I'm spending a month with one customer. You really have to think about what is a meaningful way, and the meaningful way is the way that the transaction actually happens. If I have lots of different customers and they all typically want to have no more than 3 hours of consultation, then 3-hour consultation is my standard rate. I figure out and I do a revenue model on that. If my fashion consulting, and obviously I'm not in that business, as you can see, if it is to work with one client for a month or longer, well, then you have to figure out what do they pay me for one of these big contracts. Okay, so we still have to figure out, once we know what the unit is, we have to say, well, what price do we think we're going to get? Sort of two broad approaches. One I would call sort of customer-centric, and the other one is sort of competitor-centric. Customer-centric is basically in a world in which you don't worry too much about the competition. You can just focus on the customer and think, what are they willing to pay? How strong is my value proposition? How much money do they have? You might want to segment your customers. Maybe some different customers are, richer and pay more, others pay less. But you're really driving your analysis from what you have heard, what you know about your customer. Where are you going to get that from? 2 pounds of fresh primary market research. What we said before. This is all about knowing and understanding your customer and knowing what they're willing to pay. Competitor-based, it's basically more relevant when you're in a market where you're doing things that are very similar to your competition. The first one, it's more relevant if you think you're very differentiated, you've got something that nobody else has. But if you're very close to your competitors, well, you figure out. The danger is you sort of have to really think about a cost-quality trade-off, which is, I'm offering the same good as my competitors, but, I'm sort of the low-cost guy. I'm offering the simpler service. It doesn't have all the bells and whistles. You have to take a discount on the price. Or I'm offering the luxury version. You have to add something to the price. So you sort of do a quality-adjusted comparison with your competitors. Now, here's a really easy way to get your prices wrong, is if you're not thinking properly about your value chain. So I just made up a value chain here where something costs me $2. Sorry, my slides are in dollars. But this is just the cost to suppliers, my production cost, the cost of actually producing the good, maybe, say, $5. This gets now, say that's a toy. The distributor pays $9 for acquiring the toy. The retailer pays $15, but then the retail price may be $30. So this toy sells for $30, but maybe you're selling it to a distributor. So if you're not recognizing the dynamics, by the way, there's a suggested retail price, and you typically take a discount of that because most retailers don't actually sell at the suggested retail price. So you have to figure out which of those prices is the relevant one. And if I'm a toy producer and I basically give my toys to a distributor, don't use 30, use $9, pounds, whatever. Because that is the relevant price. So when you're doing your price projection, it's very important that you do understand where in the value chain you want to be. Now, one of the things that people, sort of a classic mistake people then make is say, gee, $9, $9 for my toys. I really want to get $30, so I should go into distribution and retail myself.
Well, it's not as easy. You know, if you want to get the higher price, you have to deliver a lot more. You have to worry about doing a whole other bunch of business activities. And so you should not make your choice based on wherever the highest price is. You should make your choice on where it makes sense because you're adding a lot of value in the value chain.
Okay, so we've got some ideas on how to estimate prices. Now we got to estimate quantities. This is a lot of guesswork, but I'm going to give you sort of 4 methods briefly. This is a graph that I really like. As I said, I'm not in the fashion industry. I don't have a good... This doesn't get excited many people, but it gets me excited. So we've got time on the axis here, and we've got revenue on the axis here. And this is a classical way of describing sort of the reality of startups. You can think about this as an industry, or you can think of this as an individual firm. And you should also think of this as a firm that's actually quite successful. But even a successful firm is typically having a slow start, where your revenues go very slowly. You then often the successful ones go through a high growth phase, where things are really picking up, and there's a slowdown where you're becoming more mature, you're becoming a more established company. So when we're trying to estimate the quantities, they vary dramatically depending on where we are in the development of our firm, and sort of the S-curve, I think it's a useful framework for thinking about this. So in a top-down, you can think of this again as my own revenues, or you can think of it as the market revenue. So you're doing something new, you've got an idea, a new fintech invention that's going to change the way that we transfer money, God knows what. You're going to say, well, it's going to take 5 years for this market to develop. Let me think about the market for money transfers, something like that. It's kind of, well, the market, oops, where am I going here? I'm going way too fast. The market for money transfers is probably a high growth market today. It's not in the beginning anymore, but it's probably got a long way to go. So you've sort of has a distinction between existing markets and emerging markets. Fintech, that's an area that's really emerging for the moment. There's other things that, haven't taken off yet, and then, sort of think of food as an established market. We're going to have very different types of revenue projections for these kind of industries. What you're trying to do is you're trying to figure out basically how big is this market and how is it going to grow. A lot of secondary market research, you basically read up on the industry. And then you say, I think I have a chance to get a certain sliver of that industry. It's never 100%. Never think that you're the market. There's no such thing as a monopoly. It doesn't exist. Not in the world that we're living in. So classic mistakes we're doing there is, so everybody in China will buy my product, which is we completely overestimate the size of our market because we just think it's attractive to everybody. What we really need to do is we need to segment. I have this little app, and this app is really relevant for this geographic area and this set of people, and maybe, urban China, wealthy people are going to be interested in my app, but not the whole of China. The other mistake people make is to say, look, it's such a giant market. The fintech market is a $100 billion market. I just want 1% of the fintech market. Well, good luck. That doesn't mean anything. I want 1% of the computer market. Doesn't mean anything. So when you're saying, I can see how this market is going to develop, you got to refine your market to something that is meaningful. This is one of the classic moments where investors look at your financial projections and say, no, you don't understand your business. If you really think you're going to get 1% of the fintech market, that proves to me that you don't understand fintech. So this is where you have a chance to shine by saying, okay, let me tell you how fintech works. There's this and this and this, and we're in this segment, and we're in this geography, and therefore our relevant market is a healthy £500 million market. And we think we can get 10% of that. Now you had a chance to establish your credibility. You've also come up with a number that's relevant,
but you've established your credibility by showing you understand your market. So these kind of projections that I'm showing you are basically based not on understanding your business first, but first understanding the market that you're operating in. That's the most important thing I said in the last 5 minutes is one way of doing revenue projections is start with your market. Okay, so I'm not going to go through these examples here. A very different way is what I call the bottom-up approach. And the bottom-up approach is to say very much, let me think about what I'm doing, not about what this big market's doing, but what I'm doing. So classic example, I'm opening up a restaurant. I can basically figure out my revenues by thinking about my capacity, how many meals, how many parties can I get through for lunch, how many parties can I get through in the evening, weekends versus weekdays, and I basically model the flow of sales that I'm making. And so I estimate the number of customers who are coming through and then sort of multiply by an average ticket price. This approach really focuses on my ability to deliver. The first approach, where I talked about these markets, it is about what is the capacity out there that people want to buy this stuff. So it's basically for those who know demand and supply as an economist, it's sort of a demand approach. How much do people in the world want to buy this product? This approach, bottom-up, is a supply approach. How much can I supply? Ideally, you want to use both methods and get similar answers. So you want to see, are there enough people out there who want to buy this stuff? And then you ask separately, what am I able to deliver? What capacity can I deliver in the first year, and the second year, and the third year? And then typically what you end up doing is you say, well, my capacity, what you don't want to do. So we did this estimate. So we looked at a particular market, and we looked at the revenue projections of the company, and they thought they would have 50 million in 5 years. And we looked at the market, and when you look at the market, there's only 30 million in the entire market that is realistically out there interested in this product. So the bottom-up exceeded the top-down. That means you need, you plan to sell more than there's out there in the market, not a chance. A good scenario is where you have a bottom-up and your top-down is much higher. So you're saying this is a big market. I think I can produce this level of capacity. Maybe you've satisfied 5-10% of the market. That's a healthy market share. That makes sense. Now, if it turns out that this is a giant market and you're there at 0.1%, you might ask yourself, well, maybe I should stretch myself. Maybe I should build more capacity. Maybe I should grow more aggressively because, gee, this is a huge market and there's room for growth. So using these two approaches, market, demand, and my ability to supply, will give you a lot of information about where your business stands. Okay, so this is an example of a restaurant. They're going to have the slides, right? They're going to be made available, so you can sort of work through this. And there's a little bit more detail. Copycats, more of the same. Copycats is basically, I'm going to build my revenue projections based on what I see other people doing. So I can observe maybe there's a bunch of restaurants in the north of Oxford, and I'm going to do the same thing in the east of Oxford, and I just copy, I sort of figure out what they're doing. Or I'm going to do it in Reading, and they're doing it in Oxford. You're basically a copycat, and so you model your financials based on what other people are doing. And once you're in business, you're going to do more of the same, which says, I've done this much in the past. I think I'm going to grow at 3%. My costs are going to grow at 2%. You already have an established business. Less relevant for you, and frankly, there's more of the same. It never works because the world always changes. Classical mistakes, this is one of the reasons I like this S-curve, is you're at the beginning. If you measure what you're doing by sort of past performance, you just say, well, more of the same. I've grown in this market. I had a few sales. I'm growing. If you're in a market that has growth potential, you're going to underestimate. Your early growth is not an indicator of what's out there. Now, in a market that's taking off, you're really likely to overestimate your growth. My God, this thing is growing. But have you thought about the fact that the industry is going to reach some capacity? Here, in established businesses, it is much easier to establish good growth projections, revenue projections,
because we know what the industry is doing. Things are much more established. But as entrepreneurs, you're starting down here, and you're going to have this sort of tendency to underestimate, tendency to overestimate that you have to worry about. Okay, let's talk about costs. Costs mostly is really boring. And it's the boring stuff that makes you a successful or unsuccessful entrepreneur. It's these little details of how much things cost that are going to make or break your business. I'll skip this one. Cost of goods, you know what? I'll just go straight to the example. So cost of goods sold. It's basically how much does it cost me to produce the unit that I'm doing. And I love restaurants because everybody understands restaurants. Clearly, I doubt that many of you are thinking about restaurants. If you do, come and talk to me and we'll think twice. But, you know, sort of, here's a classic mistake that we can make. So, look, we're going to look at, you know, a market leader, coffee costs a lot, and they're charging £4 for their standard cup of coffee, and it costs them £2 to make it, suppose. Yeah, so, okay, it sounds like the cost of goods sold over revenue is 50%, so we call that a gross margin of 100% because, you know, you're taking your cost of goods sold and you mark them up by 100% from 2 to 4. And that means that Cost a Lot has a nice gross profit of £2 per cup. So now I'm a little entrepreneur and I think I've got a little idea here and I'm coffee cheapo. Well, I'm just going to come in there and make these great cups of coffee for £3. Well, let me just use the cost that I see my competitors having. They're having a 50% ratio, so my cost of goods sold is £1.50. I have a nice gross margin of 150, and I have a profit of £1.50 per cup. Correct? No. You've got to be really careful with using ratios. The right way of doing these numbers is to say, well, I'm cheaper, but probably I'm not as good and not as efficient as these guys. They get cheaper beans, and they know what they're doing. I don't. So my cost is going to cost me $2.40. So actually, you know, these numbers start looking much more conservative, and I get 50 cents, not £1.50 of profit on the cup. This is just to say, we often use other people's numbers. Just be thoughtful that you're comparing apples with apples. Or good with bad coffee. A whole bunch of expenses. This is the really boring stuff, but, you know, you have to worry. Here, you know, we could talk for hours about each of these, but you just have to sort of think through what are the main expenses. I'll say a few things about rent versus lease. As an entrepreneur, we basically try to minimize our cost, and it means entrepreneurs have sort of a natural tendency to lease as opposed to buy, to rent as opposed to own. If you want to start that coffee store and you're thinking about buying the premises, you're not in the coffee business, you're in the real estate business, because it costs a lot more to buy the premise than to operate the business. So that's true for the location. You sometimes have to think, well, some things I really have to buy them myself. I can't rent them, either because you can't rent them, or because you think it's too important and you don't want to be at the mercy of somebody else controlling a key machinery or something like that. But by and large, as an entrepreneur, every time you want to buy something, think, do I really need to buy this, or can I get it for less? And in the beginning, when you don't have a lot of money, it makes a lot of sense. Later on, when you have more money, you can do other economic calculations, because sometimes the rental is actually more expensive. If you have the money to buy the machine, maybe you should buy it instead of renting it. But early on, your reflex should always be, let's be really, really cheap. Let's see if we can rent, or even better, get something for free. Here is something really tricky. So I'm not going to talk about every expense. You have to figure out what the expenses of your business are. And, you know, there's very little to say. It's kind of boring, except that you have to do the work. You have to figure it out. Here's a tricky one. One of the expenses, you know, labor is going to be an important expense. Did I mention labor? Do I have something on labor? No. Yeah, I should have said something about labor. when you're doing your labor costs, it's very easy to just take salary and to forget that as an employer you have a whole bunch of other charges. And you know, frankly, I don't know all the details of how it works in the UK, but you know, sort of benefits is a big one. Training costs, very easy to forget that, you know, often you need to train an employee several days or weeks. And you know what? Employees kind of leave, and you have to continuously incur these training costs. And so it's one of these labor costs that's very easily underestimated. Also, just an employee often takes a few weeks before they become effective, so they're not going to be productive for quite a while. And these are costs that you're going to bear. Sometimes we want to give them stock options. I wanted to talk about this founder salary. It's kind of a weird one, but I'm talking to a room of people, many of you are thinking about becoming founders. And it's a really tricky issue, which is what's the right salary for myself? Well, a lot of founders basically have zero salary. Why? Because it's their own firm. So they're just living off the revenue because, you know, there's no distinction between the personal and the business. That's okay in the very early days, but if you want to start a serious business, you're going to have to separate your personal from your business. And you're actually going to have, as weird as it may sound, define the salary that you can draw out of your business. People tend to delay that if it's their own, or maybe it's just if it's a family business. But the moment you're working with a team that's, say, not family, you're going to have to define this anyway. Where it gets really important is the moment you take on outside money. Some founders basically make the mistake of continuing to live in the world without salary, take on investor money, and then at some point they have to go to their investors and says, oh, I forgot, but there's no salary in this contract. And they say, well, you've been living on ramen soup for the last 2 years, just keep eating ramen soup. And you don't have a leg to stand on. So it is something that needs a little bit of planning. And as a founder, our instinct is not to take a salary because we want everything to go into the business for the business to succeed. But the moment you're creating an organization that's a bit more complicated than just sort of self-employment, you have to put your stick in the ground somewhere. And so founders take modest salaries. This is not the big banker salaries that, you know, you might get in the city of London. But you have to put something in. And one trick is that you put something in and you say, well, the first few years I'm going to work below salary. But have a conversation with your investors that at some point you actually do plan to, you know, get a proper salary. Often when you model your business, you're sort of going to model it the way your business is supposed to run once it's up and running. But before you get to the up and running, you often have development costs. Those are really heavy if you have complex businesses or science-based businesses, because your development costs are maybe 5 years of research. For most businesses, it's much more modest, but you still have these development costs. And so it's important to start thinking about, well, when am I going to be up and running, sort of where revenues and costs are steady, and before that, how much money do I spend to get there? This starts to get towards figuring out the timing. And so I'm going to talk a little bit about that. How am I doing on time? Not too bad. Taxes. Yeah, remember, you should pay your taxes. Not a bad idea. The taxman will find you. Tax credits, the UK is very generous in those. So EIS, SEIS is a tax credit for investors. And then there are all sort of R&D tax credits. Those you can basically figure out. Hang on. Okay. I'll come back later to it. I'm going to tell you a little bit about cash flow in a moment. But before I do that, let me tell you a little bit of how do you typically represent some of the data to your investors. Here is a representation of, so you started to do your calculations about expenses. This is a really useful representation of financial projections. It's called the operating stack. it basically says at 100%, that's our revenue. So we're trying to express our costs as a fraction of revenue. This is a nice company because it actually has net earnings of, what's that, 15%. So the top bit is the money that we received, revenues, and we didn't spend. So that's our earnings. Everything below is our costs. And here in this case, they've broken them down by overhead, marketing and sales, research and development, and cost of goods sold. This is a really useful presentation. It typically changes over the life of the company. So early on, you would have big R&D expenses, and then, you know, maybe marketing and sales picks up as you're selling more into the market. Great representation. What you're really looking for, obviously, is that there are positive net earnings. Not necessarily at the start, but, you know, a few years down the line. So this gets us to the integrated projections. How do we do this? There's a bunch of models out there. I've given you a few links. There is sort of, you know, some models are too complex, some models are too simple, some models are the Goldilocks just right. That's my model. But the truth is, you know, there are lots of free available models. So, you know, if you want to pick up this one, that's fine. But I'm not particularly recommending it. There's, you know, you can buy software, but you can get lots of free software. That's not the problem. Putting the whole thing into a spreadsheet that then sort of arranges it into a nice looking format, you know, that's relatively easy. The point here is we have these fundamental projections, and I talked quite a bit about the revenue projections because I think that's really important. Think about prices and quantities. I've talked a little bit about the cost projections, basically saying you have to think through your business. When we integrate them, we tend to generate these three types of statements. And this is where some people, the poets really panic because now there's all this accounting language that's in there. So let me just sort of tell you what's important here. There is something called the income statement. It's basically trying to do, or profit and loss statement. It's trying to do two things. It's trying to tell you at the end of the day, are you going to make a profit or not? Is this business viable or not? What is the level of profits that the company is going to generate? This one, if I want you to remember one thing about these three things, it's focus on the cash flow statement. The income statement uses a number of, let's call them interpretations that says, well, we didn't really get the revenue yet because we haven't gotten paid, but we did something and the revenue for this activity should occur today, so we're going to recognize this as revenue to match it against the cost that we incurred. That sounds really nice, and theoretically it says we're matching our economic activity of producing something against the revenues for getting it, but it's very dangerous because we haven't gotten paid. And if we don't get paid, we can be in trouble. So as entrepreneurs, we care a lot about exactly when does the cash come in and out. And that's, the income statement doesn't give that to you because it has these interpretations in it. Frankly, it makes it more complicated. So established companies make use of it. Entrepreneurs get really fixated on a cash flow statement, and it tells you basically when is the cash coming in, when is the cash coming out. I'm paying for something before I get paid. That's important because I need to have the cash. What happens if I don't have the cash? Well, the company dies. One of the most trivial and silly statements, but unfortunately true statements, is a leading cause of company death is running out of cash. It's actually not the underlying cause, but if you run out of cash, what happens? Well, if you run out of cash, your employees go home on a Friday night, they don't get their paycheck, and they don't come back on Monday morning. Good luck. So managing your cash is one of the most important practical implementation steps that every entrepreneur has to do. And the cash flow statements helps you to plan for that. And you then have to monitor it with your accounting system to make sure that you actually have the cash in the bank on a Friday night to pay your employees. Finally, there is the balance sheet, and the balance sheet is sort of basically a snapshot in time that tells you what does your company have? And it basically has assets and liabilities. These are the things that I have. These are the things that I owe to others. And there's a whole accounting system behind that. Yes, if I were quant, I can tell you all about why they're important. But the reality of if you're just starting as an entrepreneur, this might spook you out more than you need to be. So don't worry too much about it. It's a snapshot of where your company is at a particular point in time. What really matters is the cash flow statement. So when you do financial projections, a couple of practical things. How long, how often, how detailed? Depends a lot. If you show financial projections to an investor, rule number one is they will want it in a different format than the one that you chose. So if you give them a yearly projection, they said, I want quarterly in more detail. If you do quarterly, they say, what's this nonsense? I want yearly. What level of detail? By and large, when you show somebody financial projections, I think it's good to have some high level. And then, as a good entrepreneur, you're willing to get your hands dirty and go into the detail, but you don't show the detail up front. It depends a little bit on the industry. If you have something that's, say, science-based or in the energy sector, we're talking about 10, 20 years. If you're in a retail situation, or like in a digital world, our horizons tend to be much smaller, so 2-3 years. Here's an example of how to do cash flow forecasting. So suppose this is now my cash flows, right? Remember, I told you everything that matters is cash flows. And here I've done a quarterly projection of my cash flows. And it looks fine because, I'm never running out of money. Every quarter I'm fine. But then you do it more fine-grained and you look at your monthly cash balances and you realize, actually, no, I will never get in December to that great, 40,000 pounds or whatever, because actually in the month of May I ran out of money. So when you're doing your cash flow projections, you can't just aggregate things to a quarterly level or to a yearly level. There are entrepreneurs who basically do this on a weekly basis. They project this on a weekly basis because you got to be in the green every week, not just every month. So this gets me a little bit to cash flow management. How am I doing on time? Oh, it's 5:02. You know what? I'm just going to skip this part. Classic mistakes. Here's a good one to end on. Classic mistakes. Overestimate the speed of revenues. It takes a while to generate customer interest before they buy something. And once they bought it, it takes a while to collect the money. This is a mundane aspect, but the reality of entrepreneurs is getting paid is a lot of work. Sometimes when you see revenue projections, they sort of have these spurts that come out of nowhere. Don't do that. Be able to justify using the mirror image. If you're saying I'm going to have a revenue spurt, tell me what it is that you're doing in that particular time period that justifies it. Missing costs of generating sales. It costs often money to generate the sales. And distinguishing the listed from the actual prices. So these are classic mistakes. On the cost, forget the cost of running the business. Remember, you've got underutilized assets. You're buying assets, but you're not running at full capacity right away. And make sure to have the full labor costs. We talked about that before. Cash flows, late payments and collection costs. I've kind of mentioned that already. Underestimate the true cost of trade credit. I didn't talk about that. That's in the part that I skipped. But trade credit sounds like a great idea. It basically means delaying payment to your suppliers. Be careful. It can be very expensive. There may be discounts for paying on time or early. And if you don't take them, you end up paying a lot more money. So trade credit, very seductive, could be very expensive. Underestimate the delays in raising funding. So if you're planning to raise debt or equity, 6 months lead is a minimum, because it just takes that amount of time to convince investors to put the money and actually get the money to you. And you never want to negotiate in a situation where you've got 1 month cash in the bank, because your investors can dictate terms if you know that you're going to run out of money soon. Overall, ignore the industry norms. If you think you can make a 40% margin in an industry where everybody else makes 5%, then you look like a fool. So you always want to check your financial projections against what's happening in your industry. False precision. There's no point in being super precise here. Maybe too much detail. Most biggest mistake is to have, and this typically happens in a team, where, we've got three poets and one quant, and the quant says, don't worry, I'll do the financial projections. And the poets are obviously the ones who build the real business and know where they're going. And then you look at the financial projections, and they have nothing to, they're not matched with what the other people in the team say. So the most important thing about financial projections is the mirror. It says, my financial projections represent the underlying business. Because at the end of the day, nobody cares about financial projections. They're just projections. They're a piece of paper. But they care about your business, and they care about seeing that you understand your business. And that's the key thing about financial projections. Final words of wisdom? I'm sure you knew this before. Excellent. We have a couple of minutes, so why don't we take a few questions?
Hello, my name's Bryony Leatherbarrow. I'm a poet, but I did the ACCA Accounting, Management, Finance, and I then worked in venture capital for 7 years. And I would say, looking in the mirror is not the trick. You're telling a fairy story when you're actually looking at your business planning. It's not a reflection. So it's a fairy story what you're actually planning, and it's ensuring that that actually happens. It's not a reflection. So all business plans look like you're going to make money, but obviously at least 50% of them don't make money, so it's not a reflection. You're telling a fairy story.
You've obviously been an investor for many times, and so you've seen the exaggeration that brings in. But I think that's where the mirror is. One is, as you're doing them, you have to learn to be honest with yourself. And the second one is other people, like investors, will look at your financial projection and judge you. So I think there we're on common grounds.
Any other questions for Thomas? I should say, Thomas does have another engagement, so he can't, unfortunately, stay with us for the drink. So if you do want to ask anything, do take the opportunity to do so now. No, oh, right at the back. Okay.
About what you said about not overanalyzing it or not going into too much detail. What is the problem in going into too much detail? Because if you go into detail, you get more clarity on where you're headed or the various permutations and combinations you could get into.
If the detail is understanding your business, by all means continue. If the detail is creating an elaborate fiction, as was just pointed out, financial projections are sort of depicting the good scenario. It's not about the expected scenario, it's about depicting a good scenario. But if you put a lot of detail into exactly how wonderful this good scenario is, you're probably wasting your time because there's no accuracy. You cannot predict the future with that great precision. So what you're doing is you're painting a story. You're painting a story of what this company should look like. But there's no point in putting in the great details because there's so much uncertainty and things will always change. That's what I mean by not too much detail.
Okay, I think we've probably run out of time, but as always, do just get in touch if you want a copy of Thomas's slides. Happy to send you the link to those. Otherwise, please just join me in thanking... please thank
Well, let's thank you.
Thank you very much, Thomas.